welcome to today's episode of the Daily Trader. I'm Alex Coffey, sitting in for Kevin Hinks this week as he enjoys some much-needed time off. It's January 13th. It's Monday. We're on the heels of a pretty weak equity market, not only to start this week, but coming off the end of last week. Better than expected jobs data, kind of spurring those better than expected growth forecasts going forward, but also inflation. A lot of inflation data due out this week from PPI to CPI has the market on its heels. We're about an hour into the trading week here for this particular week, the week of January 13th. And market, while it's not on its lows for the session, is certainly lower by a factor of about 0.2%. So a little bit of weakness here to kick things off. A couple names that are on our radar and will be the subject of discussion for this particular episode are in the delivery space. Now, not delivery of just anything, primarily food and grocery. We're going to be looking at Maple Bear, of course, the parent company that does business as Instacart. Stock ticker is CART, as well as Doordash. Now, both of these names got some favorable analyst commentary, price target movement, and perhaps upgrades today, but both under pressure. Let's start with Instacart. This is a company that has not been public for a tremendously long period of time, and it's sort of found its way. It's been a largely successful public offering, becoming public in the low 30s, if my memory serves me right. And I see a stock price that's now in the mid 40s. But it is off its highs by a margin of nearly 15% or so. And it's also, of course, off its recent lows. One thing that really sticks out to me as we look at this particular chart of this particular name is you have a momentum study of RSI. That's basically the middle of its range, around 50. And you also have a stock that's in sort of the middle of its recent trading range between about 40 and 50. Now, hold that thought because it may tie in to our example trade in just a moment. But I do want to go through a couple of the news items surrounding this particular name. First off, Needham upgrading Instacart to buy, and they add it to their conviction list. They have a price target of 56. These are typically 12-month price targets, so bear that in mind. Looking over, Morgan Stanley also raising the price target to 44 from 41. Now, they keep an equal weight. Now, this is going to be kind of equivalent to a neutral rating. So you got one buy, one neutral, price targets of 44 and 56. And then we also have Bernstein, which is a company that has an outperform or buy equivalent rating on this one. They see it as a value pick with a price target increased from 52 to 55. So a couple price targets over the next 12 months in the mid 50s. And then the one from Morgan Stanley here, basically where we're trading now, around 44. Of the analysts compiled by Bloomberg, there are 32 that I'm seeing showing coverage here. None of them in the sell camp, but about half in the neutral camp, the other half in the buy camp. Average price target around 50, which of course corresponds with those recent highs. Now, for our example trade, what we're looking at is that recent trading range, as I said, between about 40 on the low end and about 50 on the high end. And where we find ourselves now is pretty close to the middle of that, just on the lower end. And then also, we have volatility that started to uptick a little bit at a 54% implied volatility. We're looking at an iron condor. So it's a strategy that benefits from selling implied volatility, maybe looking for implied volatility contraction, but also range-bound activity. We have two clear levels of support and resistance. Now, ultimately, we don't know that those levels will hold or not, but we can use that price action to structure this example trade if you believe that range will hold. And so that's what we've done here with this particular example. Going out to the February monthly cycle and looking at selling that 40 put on the downside around support, 50 call on the upside around resistance, and then defining the risk by buying $5 wide wings. In this case, that's the 35 put to the downside and the 55 call to the upside. If you could get somewhere around $1.50 of a credit, that would be 30 cents for every $1 in risk. $5 wide spread times 30 cents, you get $1.50. And it creates a risk reward that's a little bit worse than 2 to 1. It's closer to 7 to 3 in this case, but you risk 350 with a chance to make 150, and it's pretty straightforward how this one performs. Stay between the short strikes through expiration. A trader would then hope that this example trade would expire worthless. If it does expire worthless, you simply keep that credit received. In this case, that's that $1.50, which, of course, based on how options are priced, is $150. The risk is it goes outside the range and then goes outside not only the break-evens, but potentially those long strikes where the risk is capped. So it is risk defined, and that risk is limited to $350. So looking for more of the same in Instacart, a name that's under a little bit of pressure today, but got some favorable upgrades and price target changes from the analysts that cover this name here on this Monday to kick off the week. Now, let's shift gears to one of its peers within its industry, and that is Dash. Now, these companies aren't identical. Is Doordash primarily functions as delivering food from a local restaurant, for example, and Instacart is mostly looking at doing some of the grocery shopping and then delivering those groceries. But you can see that they're in the similar world of delivery, particularly of food. And so a natural comparison that is often made. And when you look at this particular name, you see kind of a similar price chart, one that is sort of in the middle of its range. Let's call it between about 165 or so and 180, but far closer to the lower end of that range. RSI is also somewhat in the middle, but on the lower end as well, near 45. And when we look at this particular name and we take a look at kind of how the news flow has landed, you see similar price target adjustments taking place. Morgan Stanley, for example, raising their price target from 160 to 200. They do keep the overweight or buy equivalent rating. We see Bernstein, the same analyst that covers CART, moving to 210 from 175, keeping that outperform rating. And also kind of comparable in terms of no sell ratings across the street coverage here. More analysts do cover this name. I'm seeing 47 compiled by Bloomberg that do have some sort of coverage on Doordash. 32 of that 47 number in the buy camp. So almost 70% of analysts have a buy or outperform equivalent rating, and the rest in the hold or neutral camp. So a little bit more optimism from the street on Doordash. The 12-month consensus price target based off those analysts is 187. Looking at this particular name, similar risk-reward structure, as we're going to be risking 350 in this example with a chance to make 150, but it's only going to be half of what we looked at from an example trade standpoint when it comes to the actual strategy. In Iron Condor, as we looked at in Instacart, consists of both a short put vertical or long put vertical, and then a short or long call vertical. This is just the short put vertical, so half of the Iron Condor in this particular case. So it's a little bit more bullish, a neutral to bullish strategy. And so it kind of makes sense if you're looking at that range, holding it's on the lower end of that range. Perhaps you're looking for that range to continue to hold between about lower 160s to the low 180s. In this particular case, going to the February 21st, same expiration, the Fed monthlies, 160, 155 put vertical, looking for that same $1.50 credit again, 30 cents for every $1 in risk, sort of a loose guideline. Now, loose being a key term here, just get you that risk reward in that kind of 2 to 1-ish camp. For this strategy. Break even 158.50. You risk 350 with a chance to make 150. Stay above 160 through that expiration. You can keep that credit received. So in this particular case, these two strategies related in two related names. Selling premium in an environment where implied volatility is elevated versus its recent levels, and also prices that have kind of clear support and resistance. Just because those resistance and supports are clear doesn't mean they'll hold, but can help you with structuring those trades. Thanks as always for tuning in to today's episode of Daily Trader, and we'll see you tomorrow.